Hey everyone, welcome back to the channel, your number one source for income-oriented investing. Time to go over the high-yield income-oriented landscape on the US side, on the US stock market. Before we do that, let's check out what the stock market has done in the last month. I am filming this, by the way, on May 12th, which is a very good day for the stock market on Monday because there was some very productive US-China talks in Switzerland, apparently, so the market is rallying. So if you look at the S&P 500 in the last month, you have just up just under 8%, which is phenomenal. The NASDAQ even higher. At 10% or 10.6%. So it's been a really, really good month, definitely in the last month or so. April didn't really have a good start, but then started recovering. So yeah, let's go over the high yield landscape now. I'd like to take a moment to thank the sponsor of today's video. It's VistaShares ETF. And in case you didn't know, they have a pretty new ETF called OMAH. This is the VistaShares Target 15 Berkshire Select Income ETF. So this is an income-oriented ETF, and just like the ETF summary says here, it invests in a core equity portfolio that generally mirrors the 20 largest holdings of Berkshire Hathaway, Warren Buffett's company, right? As well as providing exposure to BRK.B directly, and they're also using options to generate high monthly income, targeting a 15% annual yield. So if we look at the top 10 holdings, you'll see that Berkshire Hathaway is the biggest holding right now, as well as the companies that Berkshire invests in. So pretty cool potential option if you're an income-oriented investor and you want exposure to Berkshire and the companies that Berkshire invests in. They also came out with another ETF, which is a similar concept. This is the VistaShares Target 15 Quality Income ETF. The stock symbol is QUSA. And if we look at the ETF summary here, this portfolio invests in equity securities that exhibit strong quality characteristics defined by high profitability, low earnings variability, and low leverage. So you could see the top 10 holdings here as well. And this is going to have a similar concept where it is potentially trying to target a 15, just like the name of the ETF says, right? 15% annual yield. So if you're an income investor, these two ETFs could be definitely something to consider, and I'll put the links to these to the web pages in the video description below so you can check them out for yourself. All right, let's start with the S&P 500 ETFs, guys. You guys know that my personal opinion, the S&P 500 is one of the best indexes you could invest in, which gives you access to the overall American stock market, the best stocks all over the world. And let's go through them because there's a lot. Let's start with the S&P 500, kind of S&P 500 funds. These are not exactly the indexes. You have GIAX, of course, which is, I believe, is still the biggest and most popular in terms of assets under management. Yeah, about to crack 40 billion here. And in my opinion, there's actually much better things than GIAX, but the latest distribution is a little bit higher than the last one. You could expect 7 to 9% yield on average with this one. You have Bali, which I think is a little bit better. It's been performing a lot better than GIAX lately. We'll see the performance in a second. You have YieldMAX, which is kind of an S&P 500 because it just has so many stocks and ETFs in here. It's kind of like, you know, I'm putting it in this category. It's hard to put YieldMAX in a different category. And then you have the equal weight S&P 500 by Invesco. You guys know I'm not a fan. I'd rather have market cap weighted and not equal weight. And a lot of people complain, or I see negativity around that the S&P 500 is so concentrated in the big magnificent 7 stocks. But if they're so magnificent, why wouldn't your exposure, why wouldn't you want the majority of your exposure to be in those great stocks? To me, it makes no sense. But anyway, we do the total return comparison. We do have 1 year of data for all of them except for RSPA. But you clearly see that Bali is the winner with YieldMAX in second place here. Doesn't surprise me because GIAX is really stock picking within the S&P 500. It's a little bit more defensive, actually. That's, you know, you see the 1 year is lower, but you see year to date in 3 months that you see that GIAX has gone down less. So GIAX is really, in my opinion, a defensive style S&P 500 type ETF. If you don't want the S&P, you want something even more defensive, and you're an income investor, that's what GEPI is designed for, in my opinion. But hey, total returns speak for themselves. Moving on to the classic S&P 500 index. Covered call ETFs, you can't get any more classic than XYLD. Rinse and repeat strategy. I'm going to give up all the upside. So this is at the money calls on 100% of the portfolio. So you're giving up all the upside of the S&P 500 for that big, massive premium. And you're going to get 1% max paid out to you. The rest is being reinvested in the fund. You have GPIX, which in my opinion is superior to GEPI because it's the actual S&P 500 with very consistent distributions, approximately 8% yield. Very consistent monthly distributions. Same management fee, very low management fee, by the way, just like JEPI at 35 basis points. You have SPY-I, very, very, very popular, over 3.3 billion in AUM, very consistent, approximate 12% yield here. And then you have a rinse and repeat IVVW, which just does 1% out of the money call every single month. The strong point about this one is definitely the fee. It's the lowest fee S&P 500 covered call ETF at 25 basis points. Do the total return comparison. We have 1 year of data for all of these. GPIX is the winner, with SPY-I actually catching up very, very closely. So these two are obviously the ones that are doing well, that are very similar. So 8% yield, 12% yield. SPY-I doing really well, catching up here. IVVW in last place for the 1 year. And then you have XYLD, of course, which is not doing that great. Better than IVVW, but trust me, once we get the 3 year, you'll see that my opinion, everything's going to beat XYLD because you're giving up all the upside. I mean, it's only normal. Moving on to the daily or zero DTE covered call ETFs, which had a nightmare called April 9th. April 9th, remember that day, guys? That's when the stock market went up 9%. The S&P went up 9%. The NASDAQ went up 10%. Well, guess what happens when you're doing a one-day call option? You really, really get screwed. So S&P went up 9%, and a lot of the zero DTE covered call ETFs only went up 3%. So they lost 6% in that one day. And now things like XDTE and T-SPY, which were beating the S&P 500, are no longer beating it. I'm going to do a video discussing April 9th. The impact it had on zero DTE in an upcoming video. Are you interested in that? Let me know in the comment section below, because I think it's very important if you're investing in the zero DTE covered call ETFs. This is actually could be a really, really big risk. This is the first time it's happened in history where the market has gone up in one day so much. Will it happen again? I doubt it, but it could happen again. If it does, it's going to be another disaster for these zero DTE covered call ETFs, unless they put some sort of mechanism in place to mitigate that if it does happen. But anyway, you have your WDTE, which is, weekly paying, very high yield, very, very, very high yield. SPY-T is a little bit more less aggressive. They target 20% a year. So the yield is always going to be about 20% on this one based on the NAV. So if the NAV goes down, your distributions will go down. I believe these are monthly. They are monthly here, I believe. Monthly. It says it right here. And these ones are weekly. Yeah. XDT is from Roundhill. Weekly distributions as well. They varied. And then you have the lowest fee daily S&P 500 covered call ETF from ProShares iSpy. You also have T-SPY, which I really like. I interviewed the CEO recently on my channel. Make sure to check it out. This one has a consistent 14-15% yield. And also YieldMAX joined the party, weekly paying, and they're obviously trying to compete with XDTE, SDTY. If we do a total return comparison, you see that XDTE is still, and iSpy are still at the top. WDTE really, really having a hard time, not doing well, guys, over the long term. It seems like the WDTE strategy is really not working. So I'm thinking of actually stop covering this one. If you like the Defiance, SPY-T is actually much better. As you could see from the total return, it's a big difference. So I'm actually going to stop covering WDTE. I think it's just not worth it. If you're into it, I would strongly suggest thinking about swapping to another one. I know there's a lot of choice here, but definitely something is definitely wrong with that strategy. not doing well, or it's just not working. Moving on to the NASDAQ 100 cover call ETFs. You guys know I love the NASDAQ 100 index. There is a lot of overlap with the S&P 500, but it's a lot more tech heavy. It's about 50% tech. So we're going to go with the classic QYLD, JEPQ. Not much to mention on QYLD. It's just rinse and repeat. Distribution did go up for JEPQ, just like JEPI, not a surprise. You have your classic GPIC, the NASDAQ 100. Same thing that GPIX does, but on the NASDAQ 100. So it's just the Q is the difference. I did include JEPQ in this, even though it's not exactly the NASDAQ 100, because it's really, really close to it. Much closer than JEPI is to the S&P anyway. You have QQQI that just won. Congratulations to NEOS award for the best new active ETF. Not sure what that award's all about, but hey. And I could see why they're going to get the award. We'll see the performance in just a second. Very consistent 13-14% yield. You also have QQA from Invesco. We know Invesco is actually the guys who manage the QQQs, the QQQ of the world. And if we do a total return comparison, QQQI is the winner. We have the 1 year data for everything except QQA, except for Invesco. But you could see that QQQI is actually beating GPIX, but their SPY-I is not beating GPIX yet on the S&P 500 one. Sorry, I keep clicking on the wrong one. Is it this one? No, it is this. Here it is. So you see that the NEOS one, the NASDAQ one is beating the Goldman Sachs one, but on the S&P 500, it's almost there. It's getting there, but for the NASDAQ, it looks like really they have a really good strategy. So NEOS is definitely the winner. Definitely seems to be the best classic, or overall the best NASDAQ 100 cover call ETF. I think it's really good. Moving on to the daily. The daily or zero DTE, and like I said, they had a rough time because of April 9th, but you have QQQY, which is also not performing great, just like WDT. And I used to own this one. I know many of you have gotten it. Maybe you still have it. We'll check out the total returns in a second, but I would also recommend thinking about swapping or getting rid of it. If you like Defiance, QQQT is better. It's targeting 20% yield, so same thing that SPY-T does. You also have QDTE, IQQQ, and QDTY. Of course, same ones, right? But on the NASDAQ, like we covered for the S&P, total return-wise, QQQY is not doing well at all, guys. I think there's something wrong with it. And just like WDTE, I will stop covering QQQY. I highly recommend you think about getting rid of this one. I don't know what's going on with it, but it can't even beat QYLD. If you can't beat QYLD, you got a problem. So it seems like maybe that daily put strategy, I don't know, it's not working, guys. So QDT is still on top as far as I could see here. We don't have 1 year data yet for the other ones as well. Russell 2000, so I'm not going to look at the total returns. A lot of these have not been out yet, but you have IWMY, 0 DTE from Defiance. And by the way, I think it's doing a little bit better than the S&P and NASDAQ. Maybe the strategy, that put strategy works a little bit better with the Russell. But you got this one. You have the rinse and repeat one from iShares, which is 2% out of the money every month on the Russell. Very, very high distributions here. Latest one at 71 cents. Maybe we could we find a 12-month trailing yield? I don't think so. Distribution yields 22%, but that's probably based on the last distribution. I wanted to get the 12 trailing, but it's pretty high. I would say it's in the upper teens in terms of yield. You have the one from NEOS, which is a good one, and then you have some the 0 DTE ones, RDTE from Roundhill, ITWO from ProShares, and also RDTY from YieldMAX as well. So personally, guys, I don't really like the Russell 2000. I think it always underperforms the S&P and the NASDAQ. So my opinion is, why bother? I'm a long-term investor, and Russell doesn't really interest me. But hey, just want to give you still got plenty of options here. By the way, you also have RYLD from Global X, right? You have RYLD as well for the Russell. But hey, my personal opinion, I would stay away from the Russell 2000. I'd just stick with the S&P 500. Let me know your opinion on that. And by the way, do you want me to continue covering the Russell 2000 ones, or should I just take them out of the video so we could focus on other things like these as we're moving on here to the more alternative sector specific Bitcoin stuff here? So you have GIAX, which is kind of like global. This is one of the rare global covered call exposures. You have about 24% yield. You have a little bit of everything. You still have a lot of US, obviously, but you see that it's a mishmash of different ETFs, and they're doing, I think, options or daily spreads on these. You have the S&P, information technology, mid-cap growth, dividend appreciation ETF, which I believe is the VIG ETF. You got some Israel, some Argentina, Europe, emerging markets, a little bit of Tesla itself. So a little mishmash of global with income. But if you compare this one with a S&P 500 cover call ETF like GPIX or SPY, this one is underperforming. SVOL, so SVOL had a really, really rough time in April because of that volatility spike. It's like the nightmare scenario for SVOL because they're shorting the VIX. So if the VIX goes up, it's not good. But they haven't changed the distribution. I'm actually pretty surprised about that. It's still at 27 cents here. So your yield is approximately in the 16, 17, 18% range. But, you know, SVOL, in my opinion, after analyzing it, well, kind of just looking at it for many years now, my opinion, it's not worth it. You might as well get an S&P 500 covered call ETF, guys, because if the VIX jumps again, it could be a big problem for SVOL. You're going to lose a lot of ground. So look at SVOL versus SPY, for example. It's a big difference in performance. And SVOL was doing well. It was beating it, but then April happened and it became a disaster. So I would recommend you also think about, do you really need SVOL in your portfolio? Maybe an S&P 500 is good enough for you. Of course, we have YieldMAX that keeps coming out with stuff every day. There's just so much. They have their Target 12 ones. If you're okay with 12% yield and you like these sectors here, they even have one recently came out with one real estate. Now they have their zero DTE. They also have an S&P, NASDAQ, and Russell to compete with Roundhill. Of course, they have their fund of funds, YieldMAX, which I covered at the beginning, other ones as well. They keep adding. I think their latest one was Robinhood, which is good, which is one I would expect, a single stock ETF. So remember, guys, it's YieldMAX. It's maximum yield and income, not total return. So just remember that if max yield is should be your objective if you're going to buy these YieldMAX ones. Curve, nothing new. They have a couple of single stocks and KQQQ as well, but nothing too interesting to me. You have some really interesting ones with Rex shares. You have FEPI, which has been around for a while. It's your classic technology stocks with cover calls. AIPI is more AI technology stocks, a little bit higher yield. And then you even have more yield with CEPI, the crypto related stocks at 42% yield. So everything related to crypto. Robinhood MicroStrategy, of course, is there. Clean Spark, which I believe is a Bitcoin miner, Coinbase, and then some other companies like Nvidia, Tesla. So this is kind of like, if you want to get into the crypto game, but you don't want to buy Bitcoin or invest in Bitcoin, maybe this is kind of an indirect way to get exposure to the industry. And like I mentioned, was a sponsor of the video. There's also OMAH, which targets 15% annual yield. They also have another one called QUSA. So there's just so many of covered call ETFs, guys. I'm going to have trouble keeping up. But I'll try to make sure that you're aware of them and you could do your own research. Remember, this is a monthly update video to really give you an overview of the high yield landscape. Of course, I can't cover all of them, but I'll tend to stay with or concentrate more on the index ones and really the ones that have higher yields as well. So moving on to the Bitcoin ones, there's two new players. So there's YBTC and BTCI, which are your classic, covered calls on IBIT, basically. But now Amplify ETFs, the guys who also do Devo and HCAO and things like that, there's they have also some covered call ETFs, which I don't cover because they're lower yields. But they came out with Bitty, which is very interesting. They're targeting 24% yield And then they have baggy, which is just like the name says, max income, targeting 30 to 60% yield. So it's pretty obvious what they're doing. Bitty, if you're happy with 24% annual yield and you really believe Bitcoin's going to go up, you're probably going to choose Bitty over baggy. Baggy is more if you just want to more maximize your yield. So if yield is more important than your Bitcoin upside, you go with a baggy. But if Bitcoin upside is more important than the yield and you're okay with a bit lower yield, 24, still not too shabby, you go with Bitty. What I like about them, guys, is that both of them have a very low expense ratio of 65 basis points versus BTCI and YBTC, where are almost 1%. So definitely some to consider. And you still have Maxi, which actually doesn't do covered calls on Bitcoin, so they capture more upside of Bitcoin. They do income with call and put spreads. And they actually raise their distribution, not surprised, to 30 cents, probably to keep up with the competition. So this one's only about 12% yield, something like that. But we have a new player to the game, MST, which competes with Misty from YieldMAX, which does covered calls on the MicroStrategy or MSTR stock. We know that MSTR is Bitcoin with leverage, basically. But what makes this one unique is that it has leverage. So it has 1.5 to 2x leverage plus a weekly call spread on MicroStrategy. So this is like MSTY on crack, basically. But the leverage does reset daily, so you really got to be able to stomach the leverage. But this is actually the first leverage covered call ETF in the US, which is pretty cool. If we do a comparison of the Bitcoin ETFs, you see that the 1 year, of course, Maxi is doing the best because they're not giving up any upside. YBTC and BTCI are in about 33-35%, so they're doing pretty well. YBIT is actually the one from YieldMAX, is in last place, not doing that well. And it makes sense because they're writing more covered calls, which means you're giving up more upside. So if Bitcoin explodes in the last 1 year, which it has, you're not going to capture that return. Again, guys, YieldMAX is for maximum yield, not maximum return. So if your objective is maximum yield, then you would consider YieldMAX. If not, then you're going to go more with another one. And now we have two new ones in the game here. And the least aggressive one is going to be this one, Bitty, it seems. But you're going to get less yield, obviously, compared to the other ones. A little bit less, though. So that is it, everyone. That's the income-oriented landscape. There's more and more ETFs that are added. I'm going to try to keep up with as many as I can. Remember that, my personal opinion here, foundational, it's very, very, very hard to beat the S&P 500 and NASDAQ 100. So that's why I always want to put the priority on those ones in this monthly series. But hey, give a thumbs up on this video, guys. I would really appreciate it. Is there any ETFs that I've missed that you want me to talk about or add to this monthly series to review? They got to remember, they got to be high yield, they got to be covered call oriented, and they have to have at least more than 6-7% yield. I know there's other ones like from Amplify ETFs, but they got to be a little bit more interesting with the yield. So let me know, and we're going to do this again next month. Take care, everyone. See you next time.